Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing. I shared a lot of data, so we're going to go through a lot of data that I follow. A lot of it's real estate market data, construction cycle. Why does that matter? It has an impact on your uranium stocks. It has an impact on oil and energy. That is the demand, the credit expansion. And I don't think people understand what I mean by that. When credit expands in the system, it goes into the system. More people have more money in the system when more people buy homes and take loans out. That is demand for commodities. That is the increased demand from the increase in the money supply. So I'm going to dive in here. We're going to go over a bunch of data. There's going to be some other data that obviously isn't my data that I'm sharing, or that I've gathered, I should say. It's that I gathered. So let's dive in here. Let's see what's going on, and I'll give you my financial opinions. If you want to follow me, it's finding_finance. And if you want to join our community, it's finding-value.com. You can use the word discount and coupon code for a discount. That's where we talk about positioning for commodities, individual companies, and what sectors are cheap at the moment. So the first thing I posted is I want to go over a couple of these charts. Household financial obligations, percent disposable income, homeowner vacancy rates, delinquency rates, single family homes. So when I look at this, let me zoom it in there so you guys can see the whole thing here. This is household financial obligations as a percent of disposable personal income. You can see in some of these recessions, they were pretty high. They had spiked higher, and then they started coming back lower in some of them. But the recessions in terms of household financial obligations as a percent of disposable income, there's no real direct correlation here. So all I'm going to say is we went to incredibly low levels in 2020, 2021. We've come back up kind of to the trend line of where we are before COVID. So in terms of financial obligations as a percent of disposable personal income, there's nothing out of the ordinary from where we are today than the mid-2010s. And we are lower than anything in the 80s, 90s, and early 2000s today. So financially, one could argue that we are far better off today than we were historically, as weird as that sounds. When looking at homeowner vacancy rate in the United States, it is very low. In fact, it's lower than I think any time in history on this chart here. So that's going all the way back into the 1950s. And we are lower, which means that there's people in homes. And the homeowner vacancy rate is very high. So the vacancies where people are unoccupied is very low compared to history. So all these people who say, "Oh, well, we've got homes out there. We've built all these homes." All I'm going to say is, I don't think that matters. We still have a shortage of homes. You can't look at some of this data and be like, "Oh, well, we have a huge surplus of homes." Then how the heck do we have a vacancy rate of unused homes so low? And what makes you think that if I owned 2 or 3 homes, that I would sell those homes? Just because I would own multiple homes, or if somebody owns multiple homes, doesn't mean that those homes are going to be rented or are going to be used for sale. You know, I know a lot of people in Minnesota, when I lived there, tons of people had multiple homes. I would say 40 or 50% at least had multiple homes. They had a cabin, generally up north or in Wisconsin, and then they had their main home in the Minneapolis area. So they lived in there and worked in one of the homes, and then they would go and vacation on the weekends or whatever time they had at their cabin a lot of the time. And they usually had a boat there, or jet skis, or some sort of snowmobile or dirt bikes or ATV or whatever. And they did lots of hunting and activities. Just because they have a cabin doesn't mean that home is available to be purchased by a millennial that works in Atlanta. I don't understand some of the arguments I'm reading on Twitter of the bear cases. We also have delinquency rate on single-family residential mortgages booked in domestic offices for all commercial banks, incredibly low. So there's no forced selling. When this turned higher in the late 2000s, that's where your forced selling came from and where you got that crash. That's where you get the credit deleveraging event, the deflation, the big D. And that's where the crash came from. Forced selling. We don't have that today. There's no forced selling. So these guys that are really talking about the real estate market and how we're going to get these big crashes, I don't believe it. I think they're full of SHIT. That's what I think. I think they're full of it. That's my opinion there. Fred data for real estate. This is more real estate data. This is median sales price for new houses sold in the United States. I've got that stupid little thing there. I don't know how you can get that out of there, but it's pulled on back some. And some people think that because this median sales price for new houses has come down, that means that the new home prices have declined. That is not the case. They're selling more small homes. And if you sell a lot more small homes, and the people who are already in homes aren't buying new homes that are larger homes, then your middle price, which is the median sales price, will decline. But that does not mean that it's declining on a square foot basis. I don't think people understand that. They read that, and I was reading some comments even on the YouTube channel that I have, and I'm just like, man, these people don't understand what median sales price is. Median sales price is the middle price. You add up 100 homes or 101 homes, it's the 50th or 51st price of the house, depending on how many homes there are. If you sell a lot more smaller homes for cheaper prices, then your middle price will go down. But that does not mean that the price of the actual square footage went down. And I don't think people understand that. But that's what it is. We've got average sales price for new houses sold in the United States. I like how these are strategically located right over it. So we've got the average sale price coming back down a little bit, but people are buying cheaper homes. So your average would also go down. Then you've got all transaction house price, which is up, making new highs here. So that's high. And then you've got housing inventory, median listing price per square feet in the United States. And that really hasn't gone anywhere. It's just gone sideways. So the square foot, the price per square foot is resilient. It's not going down. The median sales price, as you sell more homes with less square feet, you do the math, your median price will go down if you sell more smaller homes. So if you were to add up the total square footage of all houses sold, and you were to hold constant the number of homes sold, your square footage is going down. So if you sold 100 homes, on average, your square footage is declining, which then means that your median and average sales price of new homes will go lower if you're selling less square footage. Coming down. Here's construction spending and employees in construction. It's looking solid. And generally, when we get these recessions, you can see in 2006, this turned lower. In 06, 07, 08, you can see the decline of total construction spending in residential United States. We can also see a decline here in 2018 even. You had a decline here, and it bottomed out, and we started to turn higher. We had another decline in 2022. There was a decline, but we've been moving up here recently. So this thing does cycle back and forth. It's not just one straight shot, but we're at very elevated levels for total construction spending. We can also look at all employees in construction. There was a pretty big move lower in 2006 and onward. That was a big problem. Another big problem occurred in 1990. 1990 was a housing market bust. We built too many homes. So we built too many homes here. We built too many homes here. And what we haven't done is we haven't built too many homes yet. That's why we continue to be resilient in all employees in construction. We can also look at total construction spending in the United States. You can see a massive move lower from 2006 all the way to 2011. Huge move lower in total construction in the United States in terms of spending. We haven't turned anything. In fact, we are continuing to move at an elevated pace at a 45-degree angle. So we have no forced selling. We have employees increasing, total construction spending going up. Foreclosures are low, delinquencies are low, percent of disposable income in terms of obligations is low. I just don't see where this housing market bust is going to come from yet, if there is going to be one. Then we've got home builders making new all-time highs. So we've got Lennar Corp making all-time high, breaking out of its consolidation. This looks fantastic for a gigantic boom to the upside. So a lot of people who are in the crash camp, they're just wrong. We've got DH Horton or DR Horton going up, ripping it all-time highs. Toll Brothers all-time highs, and there's your consolidation. And your Meritage Homes Corporation at all-time highs. What's the likelihood of this occurring where they're all at all-time highs? If you notice, they all rolled over in 2006. You could see construction spending rolled over, employees rolled over, and the home builders all rolled over at the same time in 2006. Why do we have nothing rolling over? Oh, because we're not in a housing market bust. Delinquency rates on all loans, you can see that they are incredibly low for all commercial banks. So the foreclosures, the deleveraging coming from the system, the pressure's not there from this aspect. There it is. From this aspect, it is incredibly low. So delinquencies are not a problem. They just aren't. Here's the 4 phases of the business cycle. What's important about this is these are the outperformers during these phases. These phases are driven by the real estate market. Expansion phase, peak, contraction, and then recovery. Obviously, real estate's going to do well. It does well in expansion too. It does well in recovery and in expansion. During the recovery phase, as you come up, a lot of the growth stocks do quite well in a recovery phase. You could look at those as like technology stocks and stuff like that. So that's this phase here as it comes back up from the contraction here. The trough is here, and it just cycles back and forth, back and forth. Energy and materials do very well when we get high, and that's where we're entering. We're entering into an expansion phase. We're coming up, and I think information technology, financials, communication, all of those are going to slow down at some point. Then we're going to go into this phase here. And sometimes you get like cycles that look like this inside of this bigger cycle. But financials, energy and materials, gold, all those will do well at some point when we get into this expansionary phase of real estate and that cycle. Value investing. I wanted to cover this. Some people were asking the question, they were saying, why don't I make predictions? And I don't make predictions. What I do is I identify where the value is in the market, and then I try to make an estimate of where we're at in that business cycle. And what you want to do is this buy zone down here is where you want to buy where there's a gap between the intrinsic value of a company and the buy zone. In commodities, that's when your commodity is at a very good value. Then what you do is you kind of align it all. You want to make sure that the companies are cheap to the commodity and the commodity is cheap to other assets. And that's where I buy. Generally speaking, if you can somewhat time as best as you can and say, look, we're in an expansion phase of real estate, which is an inflationary portion of the business cycle, it's that expansion phase. Then you can see and look at your commodities, and that's when commodities go up, generally speaking. If they have a big gap, valuation gap for the commodity they're in, then that's where you want to position yourself. I don't need to make predictions. What I need to do is identify where we're at in the cycle. And again, guys, no one's going to nail this perfectly. Then you buy stuff that's undervalued, the sectors that are undervalued, and then you just sit and you wait. You wait for the market conditions to come and people to shift money in the system around differently. And they're going to shift it into the stuff that we are in. So that is what shifts it. The market conditions shifts this and the valuations change to go and become overvalued at some point towards the end of the cycle. There's many reasons, psychological reasons, why people shift money. It could be losses in bonds. It could be losses in their stocks. That forces them to move money into something else. And that something else is going to be most likely something that is undervalued. So assets flow from overvalued to undervalued. Think of it as high sentiment, which is overvalued areas, to low sentiment. I've shown you guys a ton of different charts signaling the Magnificent Seven and how overvalued it is. We've looked at commodity to stock ratios where the stocks are overvalued and commodities are undervalued. The problem that people will have is this time. This time is longer than what most people think. This rotation takes years. It doesn't take months or weeks. And everyone looks at whether something is good or bad based off of the movement of price. The movement of price is not a justification or a validation of if you're right or if you're not. It doesn't even tell you the value of anything. It just means that prices are moving up and down. What you want to do is you want to be able to come up with a strategy or a system where you can accurately identify where value is in the market, be able to buy the value, be able to patiently wait and sit and wait for the market condition to come around where that value changes the price and that value becomes realized. And then you do it over and over and over and over. Once you get the system down, then you just have to replicate it and you have to be patient and know how to work the markets. So there's many things that can bring this into a buy zone. It could be fear. It could be a bad market condition. It could be the combination of both of those things. A bad market condition with a bunch of fear. That's exactly what happened to oil. Was a bad market condition. Oil, they shut down the economy and they had nowhere to put oil. So oil traded at a negative price. That has never happened in history before. It was the greatest opportunity there was because we are in an expansionary phase of real estate. At the same time, they shut down the economy and oil went negative. That's one of the biggest opportunities I've ever seen in my life. And that's exactly what happens. The intrinsic values here, and we can price that as in terms of commodities and ratios. That's maybe your intrinsic value. And this is your commodity price going overvalued and undervalued over time. If you can buy it when it's really low and underpriced, both of these areas, that is how you make money. And then you wait for it to go and be overpriced. Now, nothing that I have watched is overpriced at this time. Oil is close to 1 ounce gold and 30 barrels of oil. That's, again, vastly underpriced in terms of the pricing of oil right now. So commodity related, we are all in the underpriced camp for almost everything. So I don't make predictions. I just go where the value is at, and then I sit and I wait. And then I find really good setups in the companies. Now, that doesn't mean the company is automatically going to go shooting higher. You try your best to get a really good entry point, Hopefully it moves off the bottom exactly when you want it to, and sometimes it doesn't. You'll have to be in it for 6 months or a year, and then it starts to move, and then I go for big gains. Big gains are, 10 times my money or greater. Now, here's another thing. It says the oil demand is at all-time high. Oil demand at all-time high? How the heck is the price down, right? Wow, I had not seen this coming given the weak price action is. Look at that. It's at all-time highs for strong demand rebound in oil in November. Oil total implied demand data, EIA report. So we've got record demand for oil, but yet oil price is low. Interesting, isn't it? Here's Tavi. He says central banks are on pace to buy over 1,000 tons of gold again. Despite the near record annual purchases, it's worth noting that these institutions once held 80% of their balance sheet in gold. Today, it's barely 20%. A return to historical average of central bank holdings 40% of their balance in gold could propel gold north of $3,000. They're coming on down. Central banks on pace to buy greater than 1,000 tons of gold again. Look at that gold buying. It's a lot. Here's gold. So however you say it, gold's expected to reach around $8,000 by 2028. It's my opinion and viewpoint. And this is the 8-year cycle. And what that 8-year cycle is the real estate cycle moving up and down. It's offset a little bit for gold. From the real estate cycle, it's offset maybe a few years. So we have this cycle, and it's just boom, 8-year cycle, up and down, right? And here we are, 7-year cycle here, 7-year cycle, and we're ready to rip to the upside. He's thinking $8,000 gold. Now, what's that going to do for your portfolio? How are you positioned for it? I like a lot of the physical metals. That's kind of where I reside. But I also have a minor exposure to the miners. I got to. They're too cheap. They are too cheap. The opportunities here are too big for me to pass up. So I got to have some exposure. We've got Felix Zulauf, big market calls for 2024 and beyond. I'm just going to go over them real quick highlights. He thinks the S&P 500 is probably going to go a little bit higher, but it will be a trap that will suck in too much capital at the wrong price and cause a big decline. So he thinks a big decline will occur after they make maybe minor new highs. Think of it as a double top. Bond rally likely to continue for now, but if the 10-year hits 3.7%, he would be very careful as bond market positioning on the long side is already at extremes. Longer term, he is bearish on bonds. So he thinks interest rates are going to go up in the longer term, but in the short term, they could go down, and I agree with him on that. Liquidity cycle is in rejuvenation phase, thanks to U.S. Treasury playing games with the Fed's balance sheet. But Zulauf does not expect this to continue for long. There's going to be a weakening in the U.S. economy in 2024, but it could be later rather than sooner. Cyclical value stocks are outperforming growth stocks, and this is telling a different story than the short-term rate market, which is pricing in many Fed cuts early in 2024. In final bull market thrust into early 2024, small caps Russell 2000 could outperform large caps. Bank of Japan, ultra-loose monetary policy. He thinks the yen will be the strongest currency in the world as it's 40% undervalued. He's bullish on the US dollar relative to other fiat currencies with the exception of the Japanese yen. But he's bearish relative to hard assets such as gold and oil. So dollar will do well against other currencies, but it'll do bad against hard assets. Longer term, the next decade will be a roller coaster market. Most of the liquidity injected into exhausted economies will go into asset markets that cause a big run in stocks, whereas bond yields will exceed their recent 5% high. So he thinks yields are going to go up on the longer term. Hard assets is where he thinks he's going to be. Silver, you can see the downward channel breakout and then the retest, and we'll see if that thing holds. We've got Art Berman here. He says, this means the Permian plays are losing their reservoir energy. Production associated natural gas has nearly tripled since 2018 in the three top producing tight oil plays in the Permian region. As these wells get older, they produce more natural gas. So you can see the gas to oil ratio is really starting to move higher. So they're getting older and the wells are depleting in shale. This is the annual associated natural gas production and gas to oil ratio from oil wells in the three major oil plays in the Permian region. And we are just continuing to move up in terms of natural gas production as these wells age. I wanted to read Gary Savage here. He says, I'm watching the dollar today. We'll have to see what happens on the jobs number tomorrow, but it's possible the dollar cycle's already left translating on day 6 of a new daily cycle. That would be very bearish if there's follow through tomorrow, and it would make it virtually impossible for the banking cartel to hold the suppression in gold. I'm on record that the cartel will not be able to hold the suppression any more than they were able to hold gold below $2,000. Here's personal interest payments have crossed 500 billion. We can see that the current levels have never been seen in 65 years. This sets the stage for rapid consumer weakening. You can see that big move and aggressive rising in terms of interest payments. Consensus now seems to be that U.S. shale companies have lost discipline and will flood the market, that oil demand is terrible, and that OPEC Plus deal is nearing collapse, and they will flood the market to regain lost market share. I do not believe any of this. Yet, with all of that bearish narrative, 2024 WTI strip is $70. This is what the energy sector looks like on a relative basis at $70 and at $80, which is still our base case for 2024. And this is still the cheapest enterprise value per earnings before interest, tax, blah, 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 and 2024 consensus free cash flow yield. These are the best value area of anywhere in the market is energy in terms of cash flow and values. So yeah, I'm going to stay there. There's no reason for me to move. New monthly mortgage payments have skyrocketed nearly $3,000 per ounce. Or $3,000 per month. That's pretty crazy. I like the $3,000 per ounce. You know what I'm thinking of. But yeah, monthly payments moving on up. We've got a ratio chart here from Grady. It shows historically undervalued commodity companies are versus the commodities index CRB. The chart is setting up for an explosive move. And hopefully that comes. But this is around the apex move after false breakout incoming, his own term and pattern. And here we are coming around the apex here, and hopefully we can get a big move in the TSX venture, the stocks on the Canadian Stock Exchange there. Look at commodities versus the U.S. stock market, guys. This is a double bottom here. Double bottom, great financial crisis, and another double bottom. Everything but commodities bubble. So this is what he's got. In this ratio, we have a positive divergence that occurred. A positive divergence occurred also in 1998, 2000. We've got 36x. When this ratio moves up, commodities outperform the stock market. The chart has that preparing for a slingshot look. And I hope we get a slingshot. It's going to be awesome when commodities just rip it. And I'm positioned for this, man. I am so ready for it. Here is manufacturing new orders have been at recessionary levels now for 14 consecutive months. The only other time this happened was during the highly stagflationary period of the double dip recession in the 1980s. There's the double dip, and we have another one here. We had 2008 as well. But we've got another ISM new orders at lows here. And that's what I've got for today, guys. So that's where I'm going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And everything's looking A-okay as far as I can tell in terms of the housing market, real estate, commodities. It all looks good. Now we just have to be patient and wait for this stuff to rotate in. All right, guys. We'll catch you later. This is Finding Value.